As AI decimates the job market, commodities dominate. Early warning signs from land. Hi everyone and welcome to Ainslie Insights, brought to you by ainslie.com.au, the home of Ainslie Bullion, Ainslie Crypto, Ainslie Wealth and the Gold and Silver Standard. Be sure to have a look. Today, welcome back Drew, who has been talking to us recently about the land cycle, but he's gone down a bit of a rabbit hole and is starting to look at how AI intersects with this. Now, AI is being something that's absolutely fascinating to me. There's so many predictions, so many things that are becoming clear, other things becoming less clear. It's all up in the air. It's a very interesting topic to discuss. How are you going today, Drew?
Good, Chris. How are you?
Yeah, good. Now, should I be worried? Like, we've said in there the job losses, but then job losses don't necessarily mean it's going to be bad for everyone. It's certainly going to be bad for some people. How are you viewing all this? And we'll bring it back a bit later to the land cycle, because I know that's something you're very passionate about. But how are you viewing the AI play here and how it's intersecting?
Yeah, I wouldn't use the word worried, but I think anyone who's not paying attention and is not concerned will be caught off guard a little bit by this. You know, the AI movement is progressing exponentially, and even where we were a year ago, it's a whole different world now. So it's you can imagine where we might be in a year or two, but it's actually kind of almost difficult to peel back the curtain beyond 2030. However, you can make some pretty clear predictions on what's going to happen with the job market, how things are going to be valued. What is valuable is going through a massive change. We're entering a phase now where we've got an abundance of intellectual computing power and human computing or human brain power, which used to be valued a lot ever since the Industrial Revolution, where physical power lost its value, and more human intelligence and skills along those lines have been increasing in value. We're now going through a transition where that's going to be massively abundant, and with increased supply and similar level of demand, you've just lost value big time on those fronts. So it's going to reshape the job market, but in that reshaping, in that transition, you've got massive amounts of job losses on the horizon. What that does to the stock market, what that does to the economy as a whole, is going to be really interesting. It's going to be quite painful, I think, for a lot of people. But it's important to sort of look at it and try to understand what has value. And if you look at an age of abundance, I think looking at what is scarce within that landscape is what's going to be valuable. And that's where commodities come in. And, bringing it back to gold and silver, cyclically speaking, we were looking at entering a phase where the stock market struggles along with the land market for a little bit, but mainly the stock market over the next 5 to 10 years, with gold and silver outperforming. And I think what that does is it ties into a larger commodity cycle where you've got that economy that's driven more by fear than by hope. Generally, anyone who knows Elliott wave structures will concur that the fifth wave, which is the final wave of the Elliott wave structure, driven by fear in commodities, tends to be really strong. But for hope-driven or speculative or sort of risk-on tech investments, which is basically what drives most of the S&P, I think over 20 to 25%, or probably over 30% of the S&P is just driven by tech. Those types of investments struggle in an environment where it's not so hopeful but more fear-driven. Now, commodities in general tend to do well in this environment, and gold and silver as well. So that's from a more cyclical and a technical perspective. But if you look at it purely from a fundamental perspective, these are things that just have limited supply. So in an age of abundance, as far as human intellect goes, things that are scarce are, assets like gold, silver, even oil, natural gas. Bitcoin might fall into that category as well. And then you've got other things like, human attention is always scarce. Human networks will always have value. But, general human specialized skills across the board start to get reshaped in terms of what's valuable and what's not. And, we can have a look at a few charts as well, but really looking at where we sit in terms of valuations from a cyclical and a technical point of view, we are looking for some sort of Great Depression style event leading into the end of this decade. And we're looking at a prolonged period of commodities outperforming. And AI, I think, ties into this in a very fundamental way, where AI will not only lead to the decimation of the job market, but it will lead to the value of scarce assets, so commodities specifically doing quite well, and also tying into that fear wave from a Elliott wave technical point of view, leading to a extended, bull run for commodities. And finally, the amount of energy that it takes for AI to really be used. A lot of people will talk about how to capitalize on the AI revolution and whether you pick certain stocks or invest in certain companies. But I think it's that old adage of the picks and shovels, the drivers of what it takes for this to really get to where it needs to go. That will benefit the most. And the AI revolution from an investment point of view, I think comes down to an energy revolution. And if you're looking at investing in energy, it comes back again to commodities. So there's a lot pointing in this direction from a technical, cyclical, and a fundamental point of view. And, looking at whether it's oil, natural gas, or even silver, there's a lot of commodities in the energy sector that are sort of not really loved as much as they could be at the moment. They're sort of fundamentally strong, but from a mainstream perspective, try to convince someone my age about investing in oil, for example. It's not gonna go really well. Everyone wants to invest in tech, and I just think the tech sector is probably loved too much, and the commodity sector is not loved enough. And that's sort of the sentiment that you'll see as well. But we look at a few charts, and it's just interesting how employment, recession, cyclical phases where stocks underperform, and a commodity super cycle all seem to be tied together with artificial intelligence and what we deem as valuable moving into this next phase. So we'll look at a few charts to back it all up, but it's just interesting that it's all sort of hinging on AI at the moment.
And just before we pull up those charts, there's so much to unpack there, but one thing that you've really caught my imagination with is something that's quite obvious, or could be quite obvious in hindsight, this idea that the Industrial Revolution, prior to that, it was all about energy and commodities. Then it switched to intellect, like that intellectual capital, the value of thinking. What I was thinking about while you were talking about what's going on in those markets is exactly that in the IT space. Well, how are we valuing those companies? Are we valuing them on the intellectual aspect of this, like going, well, they're bringing something new and innovative and creative to the space, so you want to invest in that because intellectual capital, or the power of intellect, has been where you've made money for a long period of time now. If you're saying, probably very correctly, that that's shifting, where you go, well, that is the abundant resource, that's no longer scarce at all, and energy is the thing that is scarce, or assets that require energy, or however you want to frame that. But commodities, like, that's how you are framing it. If that's the scarce thing now, that is flipping really hundreds of years of one way that we look at the world on its head, and now we need to look at it another way. And a lot of people will not be prepared for that. I thought of an analogy also while you're speaking around, you always talk about the gold-silver ratio and say, the silver can spend a lot of time, so that ratio can spend a lot of time lower, and silver can spend a lot of time really at a much lower ratio, and people just forget because it's been so long that that can happen. I think that's sort of the same, but even at a bigger scale going on here, that people forget that, well, the core commodities are the scarce asset in an AI plentiful world, because AI is going to want those assets. Everything we produce is going to want those actual commodity assets. That's quite a profound thought. I'm very keen to see these charts.
Yeah, it's going to be interesting. And again, we talk about recency bias all the time. The way things have been in our generation and even the previous couple of generations are just not how things are going to be moving forward. It's really hard to wrap your head around exactly where things are going. But, this is the power of cycles. This stuff was seen coming even a decade before. We just didn't know what was going to cause it. It's really interesting to see it unfold in real time. When we were saying that the gold to silver ratio is going to spend more than likely decades in that sub 50 region, that there should be some Great Depression scale of recession coming up. And the world is going to go through a radical change as we move from the fourth turning of this 80 to 100-year cycle into the first turning of the next cycle. This has like thousands of years of anthropological and socioeconomic data behind it, and there's always some fundamental global shift in power structures and in financial systems. And that was seen coming. Like you could look at this data like a decade or two ago and say, okay, well, around end of 2030 there should be something big. It's really interesting to see it unfold in real time, and it makes a lot of sense when you have the causes around it. But as these causes reveal themselves in real time, the cycles provide you with a little bit of an edge where you can see, well, something's going to happen, so I should bunker down. And how do you bunker down is with uncorrelated, God-given assets like gold and silver that have been around for thousands of years. So people that have been investing in gold and silver for the last decade have sort of, known that something's coming without knowing what it is. And now with AI, it's all becoming a lot more clearer in real time. But the charts and the cycles sort of, show you that well ahead of time. Now, I think what's important for the S&P is to just zoom out a little bit and look at, where we are, where we've sort of come from. And if you can see that, that's the S&P 500, going back pre-Great Depression. So you've got the Roaring 20s. Let me see if I can bring my cursor onto the screen here. Yep. Alrighty, so I'm not sure if my cursor's on the screen at the moment, but you've got the Roaring 20s. You can see leading into that parabolic phase. You've got that breakdown, you've got the Great Depression. And then from the Great Depression lows till today, you've just put in this huge move up here. This is where we sit today. Now, this, every parabolic move tends to resolve quite violently to the downside. And so how this massive move unfolds, I mean, you are getting into, even if you call it a consolidation and a zoomed out phase, this on a zoomed in point will be quite violent and quite destructive. So the S&P is, basically going vertical over this massive time frame, and it is overdue for some sort of correction. Now, here is a chart that we've looked at, quite a few times. But before which is the gold to silver ratio over 100 years. But really quickly, before we look at that, just a couple of concerning signs as to where we are and what should come next. We've been tracking the 18.6-year land cycle for a while, and the land markets tend to give you the clues that you're looking for in terms of macroeconomic situations. So, there's about a land cycle every 20 years roughly. Each turning, which we talk about quite often, the 4 turnings, has one land cycle in it. And a leading indicator for the end of that land cycle is a divergence between land and stocks. Now, we've been tracking this divergence, especially in our most recent video, saying, look, we could have early signs of breakdown in the land market, showing that the end of the land cycle is upon us. The previous end was a global financial crisis, and you saw stocks struggling for years after that, with gold and silver really outperforming. This chart here shows us that divergence in the previous cycle. You can see the phase over there marked in red, shows you stocks putting in their run up, their final run up, and land putting in lower highs and lower lows. Ever since the Trump tariff sell-off earlier this year, we have seen that potential divergence start to build. And land has not really recovered very well since that sell-off. So with the land markets, you've got that sort of sell-off in April. Stocks since then recovered really strong. They put in new highs, they put in new all-time highs, and have just sort of continued, moving up since then. The land markets had this anemic bounce, what looked like potentially a lower high, and then back down to its 50% level. Now, really at this point, okay, you can backtest the 50%, but you want to see a strong move up. Last week, we were talking about how it's back on the 50% level, and, this is not looking very good. Any break below that 50% level and multiple weekly closes below that 50% level will be the early warning sign for me that the land market's coming to an end. And we've got our first week below that. So it's not looking great for the land markets, and it hasn't for some time. But multiple weekly closes below this 50% level just essentially is showing us that this bounce of the Trump tariff lows is now in a weak position. And the next point of interest would be these lows here. Once these lows break, you've got a high, a low, a lower high, and a lower low confirmed. So you've got a macro downtrend in the land cycle, in the land markets, while stocks are continuing up, putting in their final rallies. That's really typical of the end of the land cycle. Last
Just
time we had about
Sorry, just keeping on that chart, just because I know we got a question around this, where we're asking whether it was US or sort of Australia where you were looking at this. I think that was a question someone asked on YouTube, but I have my own question to add to that as well.
Mhm.
Like, do you think people in Australia can sort of feel that? Like, they might not know exactly, they might not be looking at a chart, but they can sort of feel, well, obviously it can't, the land market can't just keep going up and to the right forever here because it's been unaffordable for some time. It's getting beyond ridiculous would be how many people would feel about that. Is that what this is also showing?
Yeah, absolutely. So, the previous land cycle peak, China bailed Australia out to a large extent. China's got problems of its own at the moment. And Australia is quite interesting because the ASX is about 25%, mining and mineral companies. So if you've got a commodity cycle that's doing really well, Australia tends to go through these cycles with a little bit more comfort. But that being said, it's not just the US. This chart that we're looking at is the US Home Builders ETF because it's the largest market and tends to lead these cycles.
Mm.
But these cycles apply to Western economies as a whole. So it might not apply to emerging markets as much. And you do tend to see emerging markets outperform for extended periods of time as these cycles break down for Western economies, which is a phase we're sort of entering now as well. But Australia is certainly not immune, and you might have sections of Australia like Perth that sort of do quite well because they are really mining focused. But areas like Sydney and Melbourne, which people have been feeling are unaffordable for really long now, should pull back a little bit. The problem is that when these cycles are pulling back, you've got a situation where the job market is also struggling. You've got more unemployment. Um, you've essentially got a recession on your hands. So it's not really a situation that most people are going to prosper in, and be able to get mortgages together and things like that. It's usually when the land markets are moving up, and the economy is doing quite well, that people are actually able to even get mortgages. So it's a funny situation where the younger generation really want to see land prices go down and house prices go down, but that usually will coincide with a environment of economic disaster. So um, preparing for these cycles and knowing that you will get an opportunity allows you to set yourself up in a situation where you're future proofing yourself in an industry that will be recession proof, having a job that will be around during these pullback phases so you can get a mortgage, setting up, making sure you're not over leveraged, setting yourself up in a situation where you can actually take advantage of these pullbacks. Most people, though, are just looking for house prices to drop without understanding that it is just a cyclical thing, and it will coincide with a period of economic hardship. So, if you've got a lot of capital on the side, these are great opportunities, but you do need to prepare for them. Now, you know, like I said, Perth has sort of been in a consolidation period for their land market for an extended period already. Sydney and Melbourne, however, have been going up. And if you've got this Western land cycle that affects, most Western economies, I would be surprised to see Sydney and Melbourne and major Australian cities be completely unaffected by it. But just zooming in on this chart a little bit, last week we were sort of here and we said, look, it's not looking great. We don't want to see multiple weekly closes in this weak area. And we have got one weekly open and close now, well, one weekly open, I should say, in this area here. In the previous cycle, we had about 15 months where this divergence was playing out between land and stocks, right? So you had about 15 months from this to a macro downtrend to where the stock market put in its high. Now, roughly 15 months from the previous peak puts you into, Q1 or Q2 of 2026. So expecting some sort of peak in the stock market early next year would make sense. And if the S&P is putting in its own peak, I don't think the ASX is going to be immune to that situation. Now, coincidentally, you have a 4-year cycle low for stocks late 2026. But if you look at where all of this feeds in together, that 4-year cycle low for stocks, it also coincides for a half cycle low for gold and silver, 4-year cycle low for Bitcoin. And you are looking at some sort of commodities boom coming out of that, probably in an environment of quantitative easing, central bank QE, more than treasury QE, which will find its way to assets very quickly. What that means, it makes sense just looking at where we are with the land cycle, where we are, the various 4-year cycles and 8-year cycles for stocks and metals, respectively. And looking at where we are in the larger 80-year socioeconomic cycles. We're expecting something along the lines of the global financial crisis, but possibly at the scale of the Great Depression. That if this downtrend in stocks starts in 26 and you get a 4-year cycle low later in 26, seeing a left translated 4-year cycle for the stock market but in that 2026 to 2030 cycle with a peak to the left of the midpoint, which is before 2028, which could put a double top in or a lower high in, while commodities are having their own blow off cycles, would tie in perfectly with all of these cycles together, because usually after the land cycle, you see multiple years where commodities outperform. Gold and silver go on their own complete, really strong blow off rallies, while the stock and land markets struggle. And so if you've got a couple of years where stocks are struggling, putting in a lower high, QE is resulting in a huge commodities boom, and 2028 is the midpoint of most of those cycles, seeing some sort of lower high for stocks while commodities blow off into that 2028 timeframe makes a lot of sense. And expecting that Great Depression style recession would also make sense if the stock market's putting in a lower high in 2028 and then going into that 2030 low. That would give you, roughly 4 years where stocks are just going down in a macro timeframe. So you've got a peak in 26, lower high in 28, and then a low in 2030, which then if it takes a couple of years to recover the highs from 2026, you've got roughly a decade of stocks chopping around sideways while commodities outperform. And that is the expectation based on every cycle, based on where we are with AI, based on where we are with the employment market. So we could be getting into a pretty tough phase for stocks from 2026 onwards, probably for a decade where commodities outperform, and then all the cycles sort of tie in well together. And 2028 being a Shemitah year is a year of interest as well, where every major peak before a recession from memory has been on a Shemitah year. So the most recent one was 2021. We had a peak. You had the global financial crisis, the dot-com peak, the roaring 20s before the Great Depression, the 1930s European recession, the OPEC oil crisis were all Shemitah years. So 2028's a year of interest for many reasons. But, coming into the next 5 to 6 years for stocks looks like a very tricky time.
Yeah, I think all of that together, and you've made those points many times, sort of pulling it together. But the new bit there for me is really the logic around AI being, as you've said the whole time, we knew something was coming, we didn't know what it would be. But AI there being the driver of that, and in a really logical way, just saying that, well, ultimately, the human aspect of that, the intellectual aspect of that, if that's being valued less and the commodity aspect is being valued more, that's going to feed directly into the cycles. It seems a bit like magic when you highlight it the way that you do and say, well, it just comes, and you knew that was going to sort of come, but you did. You've been saying that consistently. It's very fascinating to see a really logical, sort of practical reason why it's going to play out that way. Quite fascinating.
It's amazing that the same things just repeat over and over again, and what the drivers of those things are completely different. So it's like we're in a completely different world. We've never seen this before. The same things will repeat, but the things that cause them we've never seen before. And it's fascinating to watch it play out in real time, but I think it's going to be really painful for a lot of people and kind of painful to watch as well. So I'm sort of, it's exciting to watch it play out, but it's also kind of horrible at the same time. And I'll show you this chart with the stock market and job openings. Here you can see the S&P with job openings having a 1-to-1 correlation. And, you've got this sort of uptrend, and you've got this alligator jaw between the S&P and jobs. And that one-to-one correlation should snap back. Now, I don't think it's going to be jobs shooting up. I think it's going to be the S&P crashing. And that divergence started ever since AI went mainstream. That's sort of where ChatGPT was really launched. And you can see ever since then, you've got jobs just dropping and the S&P still continuing up in what looks to be a bit of a bubble. So, leading into this commodities super cycle, bringing it back to precious metals, seeing gold and silver outperform for a while, but seeing silver specifically outperform gold even for the next couple of decades would make a lot of sense. And, there's no way I'm going to go through an entire episode of Insights without bringing up this chart because I need to bring this up as many times as I can, just for people to see that the gold to silver ratio very much has spent multiple decades well above 50, which is in light blue, multiple decades well below 50, and now we're seeing multiple decades above 50 again. The silver price in dark blue, you can see when the gold to silver ratio spends its multiple decades well above 50, the silver price goes sideways in a range. And as the gold to silver ratio is dropping off and spending those decades well below 50, that's where silver spends, multiple decades going on this huge blow off rally. And talking about an energy centric move in the next couple of decades where commodities outperform, seeing silver and gold both go on multiple decade bull runs with silver outperforming gold, it just seems almost inevitable now. It's just seeing where things are going and with the AI movement and with the unemployment and this new world that we're entering in, there is a limited amount of energy, there's a limited amount of monetary metals, and there's an abundance of intellect and intelligence where, seeing these things revalued into the new world, I'd be now really shocked if these cycles didn't play out as they normally would. And again, this has, hundreds and hundreds of years of data behind it. So it's interesting to see, silver outperforming over the next couple of years makes sense. But if we're looking at multiple decades, I think silver is still really, really cheap at this point. And again, that ties into that macro cup and handle that we've looked at, and there's so many other technical indicators. So at this point, anyone watching this, in the comment section, I would just urge you to give me some counter arguments. Tell me why this is not going to work out. And I'd love to actually go down the opposite path to see why this doesn't work out. Because at the moment, I'm just seeing way too much confluence, and I don't want to be that sure that something's going to happen.
Well, I was wondering if you're going to be able to slip that chart in. You found a way. For me, the most valuable chart was actually that one showing the divergence since ChatGPT. That's fascinating in the employment and the job openings, because I think that really is the nail in the coffin to any argument that people are making that AI was not going to impact. And there were a lot of those arguments initially saying AI is not going to impact jobs. Well, I think that was pretty definitive. When you look at that chart, there's a divergence going on there. It is impacting, certainly relative to what we've seen, that everything seems okay if you just look at the stock market. But look, people will love that. Thank you once again for the deep dive and going into the specifics on all that today. Really valuable stuff as always, Drew, and I know people will hopefully rise to the challenge to give you some counterpoints in the comments on that. But thanks for your work on that today.
Thanks so much, Chris. Good to talk to you.
Great to talk to you. Thank you, everyone, for watching. We'll chat again soon.